In this video, we will be talking about financial management and how a financial manager is placed in an organization. Hi, I'm Vandana, and welcome to my channel. If you're an aspiring entrepreneur launching a venture, or a student eyeing finance as a career path, or a professional from any domain, operations, HR, marketing, or legal, and want to understand how the finance department works and how you can try to start to maneuver your thinking to get your plans, suggestions, and budgets approved, then you should stay tuned. Before we delve into financial management, let's understand the difference between two terms, accounting and finance. We tend to use these terms interchangeably in our conversations. We randomly say, check with the accounts department, check with the finance department. We really don't think there's a difference, but there is. Accounts relates to recording of the financial transactions that have happened in the past. For example, if I want to know how much has been the company's marketing spend, I will look at the accounts to see the recorded transaction over the year or over the month. While finance is a reflection of the financial implication should a particular strategy is implemented. Basically, how our future accounts will look like if we do X, Y, or Z. Future accounts would imply income statement, balance sheet, and cash flow statement. For example, if I want to understand that if I spend X amount of marketing, how does that translate into revenue? So that is future looking. Taking another example, suppose I want to increase the prices of the products in the upcoming financial year. I would try to come up with certain educated assumptions, like do I want to increase the price of all the products or it'll be only few products? How many customers may switch to competitors in case they're not happy with the price increase? So, various scenarios can be built to see various combinations of the price increases, how the effect on customers will be, how many products would I change the pricing on. All the scenarios can be analyzed, and the best option can be picked that will result in maximum profits or maximum shareholder value. So, in this way, finance is futuristic, it is forward looking. However, it heavily relies upon data. I could look at my accounting data to see what is the revenue mix, what is the concentration of the customers, what kind of products sell the most. I could also look at outside data, that is of my competitors. What kind of competitors are there in the industry? What is their product and pricing mix? What is their location? Will the customers have access to their products much easily than ours? Various data is analyzed in order to understand the impact on the decisions. So when we say that finance is futuristic and a lot of the analysis is based on educated assumptions, educated would imply that we are looking at various data in order to come up with those assumptions. Now, let's talk about how a finance department is placed in an organization and what does it do. We can look at this diagram. Here we see the financial manager in the middle in the orange box, and to either side are the investors in the green box and the firm's operations in the blue box. So what does a financial manager do? He or she raises the investment or funding from the investors and invests in the firm's operations. The investment can be in the form of equity investment or debt investment. And the firm operations, once they get the investment, they're able to make the money work and generate profits. This profits, then again, the financial manager decides whether to give it away as dividends to the investors, give the money back, give the return back to the investors, or reinvest into the firm to generate more money. Now, this whole diagram can help to understand what are the three main functions of the finance department. So, corporate finance or financial management deals with three main functions. The first is the investing decision, which is about deciding where to invest. A corporation or any business is faced with multiple investment opportunities, and this decision or whatever steps are undertaken in order to reach this decision will help pick the right opportunity that provides maximum benefit in terms of increased shareholder wealth. It is also called the investment decision or capital budgeting decision or capital expenditure decision. Capital would imply funding, what kind of funding it is, and expenditure would imply a long-term spend. So here, if I combine the two terms, the funding that I have received, I'm going to spend it on something that will give us returns over multiple period of time. It is a long-term expenditure. It's a long-term funding. If I'm buying a machine or equipment or a building, I know I'm not going to use it in this year and throw it away. I'm going to use it multiple years that will generate revenue for me for those multiple years. So here I want to separate the term expenditure and expense. Expenditure is what I just said, while expense will be something where the benefit is reaped within the year, in accounting terms specifically. So if I'm spending on marketing, if I know I did this particular ad spend, I know I gained the customers in that particular year because of that ad spend. So the expense is short term, while expenditure is characterized by long term. And capital expenditure decision becomes very important because of the same reason that these are long term investment decisions that can have impact over the long run. And that is why you really need to spend time, effort, and energy to make the decision and try to understand what you can expect. The next decision is about financing decision. Where would that capital come from? It is a decision on the source and the amount of financing that decides a capital structure, which is a mix of long-term debt and equity financing. When I'm bringing in equity financing, I'm bringing more ownership, while a debt financing simply implies a loan which needs to be repaid along with the interest. The third decision is the dividend policy decision, which is deciding whether to give the profits away as dividends or to reinvest in the terms of retained earnings. So dividends would imply current income, while retained earnings would imply future growth. Why? Because that retained earnings is reinvested, so the money reinvested generates more growth and more money. We will be covering these in detail and more in my upcoming videos, so stay tuned. Signing off now.